The statement of cash flows must be divided into three sections: operating, investing, and financing. So what is this? Well, starting with the bottom, financing. Let's say I want to first go into business. I have to first finance my operations. So any activities related to that is going to fall into that category. Once I obtain financing before I can start my business, I have to invest in myself. So I'm going to buy some plant assets. Then once I'm ready, then I open my doors. Any daily activities, that's operating. Now, it sounds a little confusing at first, but we're going to go through a full practice one. Starting with operating, starting at the top of the statement, the rule is you have a choice of using the indirect or the direct method, and this will demonstrate the indirect method for operating. FASB strongly encourages the use of the direct method. They actually tried to pass a rule that required it, but so many companies complained that the indirect is easier, so the FASB allows the indirect method, even though they maintain a strong encouragement of the other method. But as a result, greater than 90% of all companies do use the indirect method for operating. Government accounting also requires it. The other two sections, investing and financing, use the direct method. And so really you get to learn all of them. So this is an example. This is just a sample balance sheet. It's a comparative balance sheet. You see 2014 numbers, 2015 numbers. You see cash change from $74,000 January 1, 2015 to $49,400 December 31st, 2015. So you know it changed, but you don't know why or how. This statement is what explains that. But still, there's a lot of information here. So how do we split this up? Where do you begin? Well, focus on the balance sheet and determine what goes in the three sections. Then look at the supplemental information. And with this example, it would be that paragraph on the bottom. What goes in each section? And then you're going to reconcile. What are you reconciling? You're reconciling net income to cash. So learning how to do the statement of cash flows, you learn how to convert from an accrual number, net income, to cash basis. What happened to cash? Okay, here's your sample comparative balance sheet. A lot of information. First step, what goes where? Memory trick, operating is going to be current assets all the time, current liabilities most of the time. There's one exception to the current liabilities, and that's, you see the short-term notes payable is not included. Short-term note payable is how do I finance my operations? So that's going to fall into financing, even though it's current. Long-term assets is going to be investing. Long-term liabilities and equity is going to be financing, plus a short-term note. Then you have supplemental information. So of all this, remember we're going to focus on operating first. This is what I need. What's in these boxes? Down below tells you equipment was sold. More equipment was bought. That's not operating. That's investing. Company borrowed on a short-term note as well as paying down the balance of a long-term note. They also issued new stock, and they issued a cash. They declared and paid a cash dividend. That's not operating. That's financing. So what do you need to do operating? Current assets, current liabilities, accounts payable only, not the short-term payable. You're going to need depreciation expense and loss on sale because you're going to need those non-cash expenses, and you need net income because we're doing the indirect method, and you start with net income. Cash flows from operating using the indirect method. How do you get to the cash? How do you convert from accrual to cash basis? Well, first add back any non-cash expenses. And why? Because they were subtracted to get to net income, but it's not cash. Yeah, you're removing the non-cash effects to get to the cash. So we start with net income, add back depreciation expense. Now, gains or losses. I'm going to do the opposite. And why? Because a gain would have been added to get to net income. So net income's higher, but a gain is not cash. It's an accrual. I'm going to add a loss, same logic. It was subtracted to get to net income, but it's not cash. It's an accrual. So I add it back in. So I start with net income, add back the non-cash expenses, depreciation expense, add back the loss, because I'm getting from net income to cash. Okay, now I look at those current assets, and we're going to use accounts receivable as an example. If accounts receivable went up, that means revenue went up, but it was not cash. That's an accrual number. If accounts receivable went down, that means my customer paid me. So a memory trick is if an asset changes, you do the opposite. This T account example is just explaining why, so you understand it. Okay, so the accounts receivable is an asset. It went up. I do the opposite. I subtract the amount it went up, $10,830, because it went from 55 to 65,830. The difference is 10,830. Merchandise inventory went up 25,000, so I subtract it. Assets went up. I do the opposite. This asset, prepaid expense, went down $350. I do the opposite. I add it back in. Okay, now liabilities. So assets, I do the opposite. Liabilities, I do the same. But you've got to understand why to be able to remember this long term. So if accounts payable went up, that means my net income is lower and I need to add it back in, because on the other side I recorded an expense, but no cash went out. So to get from accrual to cash, I do the same when a liability changes. And if accounts payable went down, that means I paid my bill. That explains why I subtract it. Okay, so decrease in accounts payable went down 56,620, so I subtract it. And I end up with net cash provided by operating, 49,650. But this is not the total change. This is just operating. And this is just how you do the indirect method. Now we're going to look at investing. But first, let's just review an indirect method summary. You start with net income, add non-cash expenses, subtract any gains, add any losses. If the assets change, you do the opposite. If a liability changes, you do the same, and you end up with net cash provided or used in operating. The terminology is important. If it's provided, it's a positive number, cash went up. If it's used, that means cash went down. So if it's a negative number, use that word. Now let's look at the next section, investing. This is all we need from the balance sheet. Supplemental information. I sold an asset, I bought an asset. And I'm going to need depreciation expense. Even though I applied that depreciation expense using the indirect method for operating. So how do you do the direct method? Recreate journal entries. And the easiest way to recreate them is to use T accounts. Plug your beginning and ending numbers. You have depreciation expense, which will increase accumulated depreciation. Your T account is not in balance. So what happened? That means something decreased your accumulated depreciation. You're going to solve for that number. But let's look at the changes in equipment first. I bought an asset and I sold an asset. Bought it for $97,500, paying $25,000 down and signing the long-term note. Sold an asset for $46,500. Solve the accumulated depreciation. Now I have my numbers. I can recreate my journal entries. There's your first one. Sold the asset. Bought the asset. There's one more piece of information you're going to need to save for the fourth section. That's the non-cash investing and financing. Using the direct method, recreate your journal entries so that you can prove what happened to cash. $11,500 came in, $25,000 went out, and that is what goes on the statement of cash flows. This is net cash used by investing because it's a negative number. Save that other non-cash information for the end. Okay, now we'll do the third section. Long-term liabilities and equity is financing plus any short-term notes payable, even though it's a current liability. What do you need from the paragraph? You borrowed a short-term note, you paid down a long-term note, you issued stock, means cash came in, cash went out because you paid the dividend. And you're also going to need that net income number just to verify your numbers are correct for retained earnings. Okay, now let's do the same thing. We're going to recreate journal entries. First, plug your numbers, beginning balances, negative, or the ending balances. Let's start with the short-term note. We'll start on the top. Borrowed $2,000, T account's in balance, so you're done with that account. Now let's look at the long-term note. You were told you paid it down. Are you in balance? No, you're not. Now you have to dig for other information. And if you recall, the investing section, you bought an asset for $97.5, but you only paid $25 and you paid a long-term note. That explains the change to the notes payable account. Now you're in balance. Okay, now let's look at equity. Issued stock, if you recall, stock is issued at its par value. Anything over par is put in paid in capital excess of par. And those four are in balance. Okay, let's look at the last one. Retained earnings changed from $126.1 to $183,225. What increases retained earnings? Net income. Plug your number. What decreases net income? Dividends. Are you in balance? Yes. Now you're going to take this information, recreate journal entries. So dividends, cash out. Sold stock, cash in. Borrowed money, cash in. Paid down a note, cash out. This is what you need for the statement of cash flows. And it's presented the direct method: cash received, cash paid, net cash used in financing activities. And then you have that fourth section. That fourth section is required for the full disclosure principle. So to summarize, a statement of cash flows is to reconcile what happened to cash. Cash decreased $24,006 during 2015. That's what's on your balance sheet. The cash flow statement explains how and why it changed. So here we're going to put it all together. Here we have our operating using the indirect method, investing using the direct method, financing using the direct method. Add these numbers up, you get your change. It's correct, but you're not done. Next line, what was your beginning balance? Do the math, that should equal your ending balance. Now, don't just plug your ending balance and backtrack. This is where you need to end up, but this is how the statement of cash flows is presented using the indirect method. And that last line follows the full disclosure principle, the non-cash investing and financing. It does not have to go on the face of the statement as long as you have it somewhere in your disclosure notes. There will be a separate video with this same problem showing the direct method for operating. So be sure to view that one also.